So, in the initial sessions, we discussed about financial statements, we discussed about balance sheet items, financial positions, and income statement. Now, here it's a 1.4. We are going to discuss about change statement of changes in equity and equity transactions. I think in the last session we discussed few of the aspects here, right? Treasury stock, power value method. Yeah, treasury stock, then cash dividend, dividend declaration date. I have to start from here. Cash dividend.
Cash dividend, I think. What is before this?
It was treasury stock, power
Yeah.
value, and cost method.
Yeah. Till there
Oh,
we stopped.
we stopped there. Right. Okay. Now coming to the cash dividend. So in companies, we share our profit as dividends. Now, when it comes to the dividends, it can be paid in many ways. Usually, companies pay dividend in cash. So, coming to the cash dividend. Yeah. So, cash dividends. So, what happens with the cash dividend is there are different kind of shareholders. One is common shareholders and preference shareholders. So, preference shareholders they get a certain percentage of their face value as the dividend, and the common shareholders is the one who's getting anything after paying all the preference shareholders and all the vendors and all. Now coming to the dividend part. So when we pay the dividend, from where we pay the dividend? From which account we pay the dividend?
Retained earnings.
From?
Retained earnings.
From the retained earnings. Retained earnings, because there's a where we accumulate our profits. If we don't have any profits, we can't give dividends, right? Now, paying, for example, assume that your company is listed in stock market. Every day, every second, there is transactions happening, buying and selling happens in the stock market. Now, if the company want to pay dividend, to whom they will pay dividend? Okay, because after 1 second, there will be some other shareholders. So there is something called a record date, dividend declaration date, and payment date. This we will try to understand. Now, as we know, shareholders can't ask for dividends, correct? They don't have any right to ask for dividend. Only thing they can do is vote in the AGM and remove the directors, correct?
Yes.
Now, so when the dividend declaration date, once the board of directors declare the dividend, then only the dividend will become legal obligation for the organization. Until that period, there is no legal obligation for the company to pay dividend. Now, so dividend declaration is the date in which the board of directors declare the dividend. When the board meeting happens there, the board of directors declare the dividend. Then at the same time, the accountant will record a journal entry moving the amount from the retained earnings to the dividend payable. Clear?
Okay.
Then comes the record date. Now we have to decide to whom all we have to pay dividend. So for that, what we do, when the directors declare the dividend, they will also declare that this is a particular date is the record date. Record date is the date at which they will take the list of the shareholders at that particular date. So whoever want to get the willing to receive the dividend can hold the stock for that date. Clear? For example, March 31st is the date the company is declaring as the record date. Then on March 31st closing, whoever is our shareholders, they will get the dividend. So why? Because the company will take the record list of shareholders on that particular date from the stock exchange, and only to those people the company will pay dividend. Then comes the payment date. Payment date is some other date when the dividend is being paid. Clear? Now, so the common form of dividend is the cash dividend. An entity declares a dividend based on a dollar amount per share. Each shareholder receives cash as a form of dividend distribution. On the declaration date, the board of directors formally approves a dividend. A declaration of a dividend decreases the retained earnings. So our journal entry on this particular date will be retained earnings account debtor to dividend payable. Retained earnings is always having a credit balance, so we are going to debit the retained earnings and credit the dividend payable. Then all holders of the stock on the record date are legally entitled to receive the dividend. There is no impact on the firm's accounting equation in the record date. That means on the record date, this is all the administration work we do there. No journal entries has been passed on the record date. Then comes the payment date. Payment date is the date in which the dividend is paid. When you make the payment, your entry will be dividend payable account debtor to cash or bank. Clear?
Yes.
So let's go through this example. On September 12th, the company's board of directors declared $3 per share dividend to be paid on October 15th to all holders of common stock. On the date of declaration, 40,000 shares of common stock were outstanding. So 40,000 shares into $3. 120,000 is the dividend we are going to pay. So your entry will be retained earnings account debited to dividend payable. Now, when you take from the retained earnings, what happens? Stockholders' equity will decrease and your liability increases. Okay. Then on the payment date, what happens? Dividend payable account debited to cash. Your liability decreases as well as your asset also decreases. Now, next one is that property dividend. Now, for example, company needs the money for some other purposes, for maybe for reinvestment purpose or something else. But company have some inventory in hand, or sometimes if it's a property business and all, they might have land in their hand, or they might have any idle land. So the company will do what they will do is they will declare dividend on the basis of the land or whatever the tangible property they are having. So, for example, we will be distributing inventory to the shareholders in the form of dividend. Clear? So now, before that, what you have to do is before we transferring the amounts, like before these two journal entry happens, there is one more thing happens in this case of property dividend. That is, you have to, for example, inventory, you're going to declare distribute as dividend. Then what you have to do is you have to remeasure the inventory to the fair value. For example, 10,000 dirhams was the inventory you're holding. Now, when you revalue it, it becomes 15,000. So 15,000 we have to make it in a P&L. Clear? Then this 15,000 is being taken from the return earnings and pay as dividend. Now, property dividend. When an equity entity declares a dividend consisting of tangible property, the property is remeasured to fair value as of the date of declaration. This is important. Remeasurement happens on the date of declaration, not on the date of payment, because this thing come in a examination question which will confuse you. So remeasurement of fair value of property happens on the declaration date, and any gain or loss on the remeasurement is recognized in the statement of income. Then the carrying amount of retained earnings is decreased to the fair value of the property to be distributed. Then the property is distributed as dividend. Now, let's see this example here. On 1st August, the company's board of directors declared a property dividend to be distributed on December 1st to holders of common stock. On August 1st, the carrying amount of the land to be distributed is 50,000 and its fair value is $80,000. So what happens now? The book value is only 50,000. So what we have to do? We have to increase the land value. So your entry will be gain on land remeasurement account debited 30,000. What do we say? Land value account debited 30,000 to gain on land remeasurement. Clear?
Yes.
Okay. Now what happens now? After this particular journal entry, your property value became 80,000. Clear?
Yes.
Now, then on declaration date, one more journal entry will be passed. Okay, let me put that here. Oh, 30. Count up to 30,000 to gain on remeasure 30,000. So now before the value was 50,000, 30,000 added, so the value became 80,000 for land. Okay. Now, so on declaration date, this is all happening on declaration date. Same thing happens here also. On the declaration date itself, one more entry will be passed. That is returned earnings. How much? 80,000 we have to move from to dividend payable. 80,000. Clear?
Yes.
And on the payment date, the entry will be dividend payable conducted to property. 80,000. Clear?
Yes.
All good? All good, yeah. Then. Then comes the stock dividend and stock split. So what is the stock split and stock dividend? Now what happens with the stock dividend is that uh, company may not have any property, or company may not have cash also, but the company needs to make their shareholders happy. For that purpose, company will declare dividends in the form of stock. So for example, if I'm having 5 stocks, I'll be given one more stock additionally. Clear? As free of cost. As an investor, I don't have any additional cost. So that is called a stock dividend. Okay. Then we will be discussing about stock dividend and stock split also. Stock split is where, okay, let's finish the stock dividend. The stock dividend involves no distribution of cash or other property. Stock dividends are accounted for as a reclassification of different equity accounts, not as liabilities. Now, so what happens here in stock dividend, when you declare, we take, so normally when we issue shares, what is your entry? Or what we say here? Okay. Ultimately, our entry was returned to property, right? So normally we do return earnings account after property to us, right? When you are distributing property. Here the entry will be common stock. Clear?
This will be on the payment date,
Declaration.
no?
Declaration. Yeah, payment date. It will be. Okay. And one more thing comes here. When you say common stock, there will be fair value, par value, and additional paid in capital. Paid in capital. Clear? So additional paid in capital. Like for example, par value is 1 dirhams and the other one is 9 dirhams. So like for example, 8,000 shares has been issued, then 8,000 and this is 71,000. Clear? Okay. Let's go to now. So stock dividend involves no distribution of cash or property. Stock dividends are accounted for as reclassification of different equity accounts, not as liability. The accounting for stock dividends depend on the percentage of new shares being issued. So small stock dividend, that is an issuance of shares less than 20% to 25% of the previously outstanding common shares, should be recognized as stock dividend. Now, so why it is saying 20 to 25%? Because in US, each states have their own rules. Some states will consider 20% as stock dividend. Some considers if it is only above 25%, less than 25%, it will be considered as stock dividend. Clear? Now, for example, I am having number of shares, 1,000. No, 1,000 shares I am having. So now company is going to give me for each share, they are going to give me 1 share. Then how much shares I will get here? Each 10 shares, I will get 1 share. Then basically 10%, right? So I'll get 100 shares. Got it?
Yes.
This is stock dividend. Clear?
Yes.
Now, if I'm on the same case, if they are going to give me 25 shares, or they are giving me 25% of my shares as dividend, then this will become stock split. Clear?
Okay.
Dividend as stock split. Okay. Now going to second one. Okay. So large stock dividends and issuance of more than 20% to 25% of the previously outstanding common shares should be recognized as a stock split in the form of a dividend. Okay. Now, in accounting for a stock dividend, the fair value of the additional shares issued is reclassified from retained earnings to common stock and additional paid in capital. So now, what happens here? If it's a stock dividend, what we do? We will take the fair value. Clear?
Okay.
Okay. Fair value means how we will take the fair value. Uh, Same class of shares which is listed in the stock market. That's the rate we are going to take here. Clear?
Okay.
Now, so a company's board of directors declared and paid a 10% stock dividend on the 45,000 shares of common stock outstanding, $1 par value. The stock was trading at $15 per share at the declaration date. Clear? See, here that is one thing. Here we don't have declaration and payment date separately. Both are same date. Clear? Let's see.
Okay.
Yeah. Okay. Now, so 45,000 shares into 10%, that's 4,500 shares we'll be having. So 4,500 shares into 15 is the total value. This, this will take from the retained earnings. Okay. Then what goes to common stock? That is 4,500. And balance 14 into 4,500 will go to your additional paid in capital. Clear?
Yeah.
It is on the debit and these two are on the credit side. Okay.
Okay.
For a stock dividend that is accounted for as a stock split in the form of a dividend, the par value of the additional shares is reclassified from retained earnings to the common stock. So this is the main difference you have to understand. If that's why we have to check the percentage. Clear percentage of the new issue. If the percentage of the issue is more than 20% or 25%, then what happens? The accounting treatment changes.
Okay.
Okay. Now the above example, what if there was 45,000 shares? Okay. So 45,000 shares into how much? 40%.
4,500 shares.
No, the 4,500 is a new shares issue, right? Total there was 45,000 shares.
Ah, okay.
Okay. Now under this 40% is the stock split. Now what happens? 18,000 shares will be issued. Clear?
Okay.
In this case, your entry will be returned earnings account after 18,000 shares into $1 into common stock. 18,000 into $1. There is no additional paid in capital. Clear?
Okay.
All good? Now, basically, by doing this, what happens is, why we are doing this separately? Because actually, we are not giving dividends, kind of thing, which we are trying to split the stock. Okay. As an investor, for example, here there was what if the 45,000 shares was holding by me? It was $15. Clear? Now,
Okay.
the new shares also issued 4,500 into 15. So the total investment I will have is 74,000. Clear? 7,42,000. Now, coming here, before it was 45,000 shares. Correct.
Mhm.
And 40% of the shares I am giving as stocks dividend. Basically, here The total number of shares is 63,000. And this is the value. This is the value here. Sorry, this is 45,000. Basically, what happens here is you're simply dividing your shares. Got it? The par value will be the same. As an investor, the money which you invested will not increase.
Just
Understood?
the number of your shares will increase.
Yeah, number of shares will increase. Got
So
it?
that's the only benefit.
Yeah, that's the benefit. So you'll understand when once I talk about stock split. Okay, till now you're clear, right? Stock split accounting.
Yeah.
Stock split in the form of dividend. Clear?
Yeah.
Okay. Now coming to the stock split. So what is stock split is now, for example, my face value of the share is $10. Okay, and I am having number of shares is 1,000. Okay. Now, what happens here, or for example, my face value is 100. Okay, not face value, par value for the same state. Okay, par value is $100. Clear?
Yeah.
Now, what happens for this? Okay, before I tell this, I will tell you a story. Then you will understand better. So, while I was doing my college, I used to invest in stock market. Okay, so
Mm-hmm.
at that time, I used to trade with how much 10,000 rupees or something, very small amount. So there was one stock in BSX stock exchange, which was Sesagova. The stock exchange stock's name is Sesagova. Okay, and one share price was how much? 3,500 rupees at that time. Okay.
Okay.
Now, as a small investor, I'm investing only 10,000 dirhams. How many shares I could buy maximum? One, two, right?
Two.
Maximum two shares I could buy. Correct.
Yeah.
Now, because I had other investments in my portfolio with this 10,000 dirhams, I could not afford to buy Sesagova. Okay.
Mm-hmm.
So what happened? I waited and I saved some money and I bought one share. Okay, I was desperate to buy this one share. So I bought this one share for 3,500. Clear?
Mm-hmm.
Now, after I bought the shares, company declared a stock split. Okay. So how much money I
Okay.
invested?
3,500.
3,500. So stock split is that whoever having one shares, their share will be divided as 10.
Okay.
Now how many shares I have? 10
11.
shares. So what is my each share value? Is it 3,500 into 10?
Yeah.
Definitely not, right? They're dividing one share into 10.
Dividing. Yeah.
Okay. So each piece will be
Divided by 10.
divided by 10. Clear? So each shares value became 350. Got it?
Mm-hmm.
So did my investment increase?
No.
No, my total investment is the same, but the per dollar per share value became 350. Now what happens? This is more liquid, right?
Yeah.
Poor people also can buy their shares. So the share become more liquid. Clear? So
Mm-hmm.
this process is called the stock split. Clear?
Okay.
Got it? Yeah.
Yeah.
Now, let's go through this. Stock splits are issuance of shares that do not affect any aggregate par value of shares issued and outstanding or total equity. Stock split reduces the par value of each stock and increases the number of outstanding shares. So what happened here? Par value decrease and the number of shares increase. Clear? No. No entry is made and no transfer from retained earnings occurs. The primary purpose of a stock split is to improve the stock's marketability by reducing its market price and proportionately increasing the number of shares outstanding. Clear now?
Yes.
Okay. So this is why. So basically, the idea happens here. Stock split. That the same thing almost happening here. If you are giving 40% shares as stock dividend, basically you are dividing the number of shares, correct?
Mm-hmm.
So that's why our treatment here is different. That's why we call it as, even though you are giving stocks as a dividend, but we will consider it as a stock split.
Okay.
Okay, but one thing is happening here. The common stock par value will increase. Clear? Number of shares and the par value increases here.
In
Got it?
stock dividend.
In stock dividend as a stock split. Clear?
Par value decreases, no?
No, no. Par value decreases in this case. Stock split only. Okay. I will show you this thing. Look here. It is there. So when you're having a small stock dividend, what we'll do? We will the new issues will be on the base of fair value. Correct.
Mm-hmm.
So when you fair value, that means we take the amount from the retained earnings, and common stock will increase. Correct.
Yeah.
Additional paid in capital will increase. Clear.
Yeah.
And retained earnings will decrease. Clear.
Yeah.
And the total stockholders equity, there is no change. Only moving from here and there. It is not going outside the equity formula. Got it.
Okay.
See, what is the formula for equity? There is common stock, then additional paid in capital, then we have retained earnings. Like for example, we had 10,000 in common stock and 100,000 in additional paid in capital, and retained earnings was 500,000. So what is your total equity here? 610. Clear?
Yeah.
Now what happened here? Uh, we are going to declare a stock dividend. So we are
Okay.
taking, for example, the above case we will take. Where did it went? So these two examples we will take. Okay. Now in this case, what happens if you're doing this? How much retained earnings will reduce? 67,500. Correct.
Okay.
And common stock will increase how much? 4,500. And additional paid in capital will increase 63,000. Correct. So what is the total here?
Oh, okay.
Understood. Here
Yeah.
we did small stock dividend, right? Small
Mm-hmm.
stock dividend. So that's what we are saying here. When you do the small stock dividend, your common stock increases. Okay. Common
Mm-hmm.
stock increases, additional paid in capital increases, and return earnings decreases. But the total equity will be the same.
Okay.
Next is a large stock dividend. In this case, what we said, we will take only the return from the return earnings, we will only take the common stock amount, par value only. Correct.
Mm.
So here, common stock plus the par value happens, and this is the same. And retained earnings will reduce how much?
18,000.
18,000. So here also your total will be the same. Got it?
Yes.
Okay. Then comes the stock split. In stock split, there is no adjustment. Nothing will happen. Only a memorandum entry happens where they say the number of stocks is being divided. Clear?
Okay.
All good? Yeah. Then limitations of statement of changes in equity. The financial statements report accrual basis results for the period. The company may recognize revenue or expenses and report net income before any cash was actually received or paid. The data for retained earnings is not sufficient for assessing the amount actually available to be reinvested in the company or to pay dividend. Why? Because in the retained earnings, we will be showing the accumulated profits, and this profit may be in AR inventory or maybe inside the fixed assets. So from the return earnings alone, we can't declare the dividend and pay, right? For example, once we declare the dividend, we should have enough fund to pay the dividend. Otherwise, we will be in trouble. Got it? So
Hmm.
we should check the return earnings if there is enough return earnings. Also, we have to check what?
Working capital,
Working capital,
like
bank
cash.
balances, right? Cash and bank availability should be checked. Clear. Now, the statement of changes in equity illustrate the company's equity base on a specific time period, which means equity may vary significantly a few days before or after publication of the statement. The same weakness we will be seeing in the balance sheet also. So, balance sheet of statement of financial position will be prepared on a particular date. So, it can be different in before and after the balance sheet date. Clear?
Hmm.
No. Uh, let's do one thing. Let's do some question and come back. Clear.
Okay.
Um, external financial reporting. Owner security. This is what we discussed, right? Statement of owner security. There's only 6 questions. Okay. Let's see this. No, this is not the one which we were looking, right? Second.
Um, Statement of comprehensive income. That one. No?
No, the owner's equity is the one we were discussing, right? Next is the cash flow.
Hmm.
Comprehensive income statement is the income statement.
Oh yeah.
Hmm. Let's do. A statement of changes in stockholders' equity shows a what dash.
Reconciliation. A.
The return earnings, not only return earnings, we will see all of the accounts also, right? In the stockholders' equity. We'll have common stock opening and closing balance and the reconciliation, additional paid in capital, treasury stock, all of them comes, right? So it should be
So D.
reconciliation of the beginning and ending balance in the individual stockholders' equity accounts, right?
Hmm.
Let's see. Yep. Okay. Computation of the D. The firms are required to present reconciliation of the beginning and ending balance of the stockholders' equity. The statement of changes in the stockholders' equity reports the changes in the each stockholders' equity account and its total stockholders' equity during the year and reconciles the beginning balance in the each account with the ending balances. Clear?
Hmm.
What is the primary purpose of the notes to financial statements? Primary purpose of the notes to financial statement.
B.
It will be B, right? B. Correct.
Hmm.
Yep. Next. Which of the following is not a part of full set of financial statement, but is a part of general purpose financial report?
Uh, Comprehensive income?
When we say full set of financial statement,
Not a part of it, no?
yeah,
Notes.
notes, right?
Yeah.
But it is a part of general purpose
General
financial
purpose,
report.
yeah, notes.
Okay. So when you say a general purpose financial statement, which we are going to issue to the public, correct? So everybody
Yeah.
is going to use it. So there should be more details to the financial statements.
Yeah.
Okay. Hmm. Next is the cash flow statement. Okay. Now, all good? Do you need a break? Take a 5 minutes break and come back. Okay.
Okay.
Yeah. break. Right, let's start.
Okay.
Okay. Now, Shilpa, you there? ഇല്ലെന്ന് പറഞ്ഞിട്ട് ആരും അല്ല ഫോൺ ചോദിച്ചിട്ട് പോയെന്നറിയാണ്ട് ചോദിച്ചതാ. ഇന്ദു, you there? Okay, let's start. Okay. Now, statement of cash flow. So when you, for example, what is the purpose of having a cash flow? So when before we were not that into, usually in the finance world, people don't used to prepare the cash flow statement. Everybody was concentrated on the balance sheet and P and L. But what happened? The balance sheet and P and L will not give you an idea how much cash you are having and from where all you are generating cash. The cash can be generated from many ways, many places. Like it could be financing activity or investing activity, or it could be operating activity. Now that's why we prepare a cash flow statement. So if you look into a company's P and L, company may be profitable, but there could be chance that this company won't have a liquid cash because all the money may be blocked in AR or what we say inventory or any other fixed assets. So once you prepare the cash flow only, you will understand how much cash you have or you generated from the operating or financing or investing activities. Now, statement of cash flow. The primary purpose of the statement of cash flow is to provide relevant information about the cash receipts and payments of an entity during the period. To achieve this purpose, the statement should provide information about cash inflows and outflows from operating, investing, and financing activity of an entity. This is the acceptable order of presentation. That means whenever you present your cash flow, it should be in this order. First operating cash flow, then investing, then lastly the financing activity should come. Then the statement of cash flow should help users assess the entity's ability to generate positive future net cash flows and its ability to meet obligations in its and its financial flexibility. Now, when we say cash, it is cash and cash equivalents. So cash equivalents means those short-term investments which we can recover in full from, like for example, cash, bank deposit, some sort of treasury deposit you have, which is having maturity less than 3 months and all. So when you withdraw it also, you won't lose much of the value. Those things comes under cash and cash equivalents. Now the statement of cash flow explains the changes in the cash and cash equivalents during the period. It reconciles the period's beginning balance of cash and cash equivalents with the ending balance. Now, this is the format. So we'll have the net cash provided or used in operating activities and cash provided by or used in investing activities, then cash provided or used by financing activities. You get the net cash during the year, cash and cash equivalent during the year. With this, you will add your opening balance, then you get the closing balance, which should match with your balance sheet. Now, so operating activities. So operating activities are all transactions and other events that are not financing or investing activities. Cash flow from operating activities are primarily derived from the principal revenue producing activities of the entity. They generally result from transactions and other events that enter into the determination of net income. Then the following are the examples of cash inflows from operating activities. That is cash received from sale of goods and services, including collections of receivables. Then cash received from royalties, fees, commission, trade debt securities, and other revenues, and cash received in the form of interest or dividends. Then cash outflows are cash payments to suppliers for goods and services, cash payment to employees, cash payment to government for taxes, duties, fines, etc., and payment of interest on debt. Then see, here also one thing you need to understand, if your business uh, all these categories will be decided on the basis of the type of business what you do. Now, for example, you are into financing activity. Okay, so you're running a bank or something. Then whatever the interest comes, it will be part of your operating activities. And sometimes if you have a loan, uh, what do we say, or you have invested somewhere, then those interests will be part of your investing activities. Clear? Then coming to the investing activities, cash flow from investing activities represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. The following are the examples of cash outflows and inflows. So cash payments to acquire property, plant and equipment, intangible assets and other long-lived assets. That means if you pay anything to purchase plant, property and equipment or intangible assets, that means any copyright, patents and all, if you paid, then those are cash outflows. Then cash receipts are the from the sale of plant, property, equipment, intangible assets or other long-lived assets. Basically, this is two sentences in one sentence. Then cash payment to acquire equity and debt instruments of other entity for the investing purposes. If you pay money to get the shares of the other companies, it's actually investing activity. Or cash receipts from the sale and maturity of such as held to maturity securities and available debt securities or the other entities for the investing purposes. Either you buy some shares or debentures of other company, then that's cash outflow. If you're selling those, then these are the cash inflows from those activities. Then cash advances and loans made to other parties. Cash received from repayment of advances and loans made to other parties is investing activities. Financing activities, cash flow from financing activities generally involve the cash effects of transactions and other events that lead to issuance, settlement, or reacquisition of entities, debt, and equity instruments. So then, issuance means if the company is issuing shares or debentures or bonds, then it will generate a cash inflow for the company. Then settlement means you are paying your debentures or preference shareholders and getting your shares back or debentures back, then you pay them. Those are cash outflows. Then reacquisition of entities, debtor, equity instrument like treasury purchases, treasury stock purchases and reissue will come under that category. Then the following are the examples of cash inflows from financing activities, that is cash proceedings from issuing shares and other equity instruments, cash proceedings from the issuing loans, notes, bonds, and other short-term or long-term borrowings. And following are the examples of cash outflows from the financing activities, that is cash repayment of amounts borrowed, payments of cash dividends, cash payments to acquire or redeem the entity's own shares, cash payments by a lessee for a reduction in the outstanding liabilities related to finance type lease. If you're having a finance type lease and your payment, any principal payment you're paying, it will be part of your financing activity repayment, cash outflow. Then what are the disclosures you have to show in your cash flows? Now, information about all non-cash investing and financing activities, that is investing and financing activities that affect uh, recognize assets or liabilities but not cash flow. Now, my question is, when you issue debentures, not debentures, what we say, dividends to shareholders, that is property dividend, should we show it as a notes or not? We discuss about dividends, right? If it is a cash dividend, we will automatically show in our books. But what about the property dividend? Then you have to give it in the notes because it's a non-cash transaction. Clear? Then, or if you're going to settle any of your AR with AP, then these kind of non-cash settlement also you have to give in the notes. The following are the examples of non-cash investments, investing and financing activities. Conversion of debt to equity. Okay, that means there is some convertible debentures or convertible bonds you're converting into equity. Then there is no cash transactions involved. Still, you have to show in the notes to accounts. Then acquisition of assets either by assuming directly related liabilities or by lessee's recognition of a finance or operating lease. Then exchange of a non-cash asset or liability for another. So in preparing cash flow, we have two methods. One is direct method and one is indirect method. So when you talk about the operating activities, that's the only place we have two methods. For investing and financing activity, whether you follow indirect method or direct method, there is no change going to happen. Uh, Indirect method of presenting operating cash flow. Here, what happens here? Uh, this indirect method help you understand where did your money go, because here we start the indirect cash flow with a profit, net profit or net loss you take from the P&L is actually continuation from the P&L. So you take those amount here and you do the adjustment here to figure out what is the operating cash flow. So what are those adjustments you are going to do? Now, non-cash revenues and expenses that were included in the net income will be removed, such as depreciation, amortization expenses, impairment losses, undistributed earnings of equity method investments, and amortization of discount and premium on bonds. Now, coming to each item, depreciation is a non-cash expense which we have reduced from our net profit. So what happens here? We will add back those depreciation, and any amortization expenses also we will add back. Then any impairment losses you have record, you have to add it back. Then any undistributed earnings of equity method investments. So now what happens in equity method accounting? Did we discuss those things? Consolidation, equity method accounting, and all? No, right?
No.
No. Okay, so if you are doing an equity method accounting, then what happens? Okay, you want to understand that, I will go just explain that part first. See, you have invested in another company, and if you're having more than 50 percentage or more voting rights, then we call you have control over the other company. Clear? Then if you're having 20 to 50 percentage voting rights, we call it as significant influence. If you're having less than 20 percentage, 20%, then you don't have any control, no control or no influence. Nothing is there, right? Now, if you're having more than 50 percentage voting rights in another company, in accounting aspect, what you have to do is you have to prepare consolidated financial statement. Financial statements. If you're having significant influence, you have an option, either fair value option or equity method of accounting. Or if you're having less than 20%, then fair value. So what happens here? If you're having less than 20% shares in another company, your shares will be valued and recorded in the books in the fair value. Clear? Fair value means the market value. Now, if you're having more than 20%, up to 50% shares in another company, you have to record your books in equity method. Now, so consolidation, I hope you know, right? In a vague way, at least. So in consolidation, what happens? This is a parent company's financial statement. This is a subsidiary's financial statement. You simply merge two of them. And there are few adjustments coming that we will discuss in the consolidation part. But the basic idea there is you will consider both this as a single company and take, for example, parent company is having 50,000 fixed asset and subsidiary is having 10,000 fixed asset. Then when you prepare the consolidated statement, total 60,000 fixed asset the company will be having. Clear? But Coming to the equity method. So equity method of accounting is very simple. If you say, for example, I'm starting a new business. Okay. Business for 200,000. Okay. 200,000 is my investment. Total investment needed. Business investment is 200,000. So I will ask Betsy uh, to invest 25% in my company. Okay. Now, how much money she will invest? 50,000. Clear. So in Betsy's books of accounts, 50,000 is the investment. 50,000. Clear?
Yeah.
No. And this year, my company made a profit of made this year is 100,000, for example. Okay.
Mm.
Now, so if you decided to stop doing business with me, how much money you will take from me? You don't want to be partner with me. Will you take 50,000 and go?
No.
No. How much you will ask? You will ask at least 50% of the profit which I made, right? Not 50, 25%. Correct.
25%. Yeah.
So total money will be profit in equity investment. 25,000. Clear. So your total outstanding, your total investment value will be 75,000. Clear? Got it? Understood?
Yes.
But when you prepare your P&L, you will have a line item called profit share in equity instruments investment. Clear?
Okay.
Understood that. Then uh, I paid you dividend, like 5,000 dirhams or 10,000 dirhams. I paid you dividend. So total
Okay.
outstanding you have to get from me is only how much? 65,000. Clear?
Yeah.
So normally, if you are recording a dividend, where do you record? In P&L or balance sheet? Dividend
P&L.
received. Dividend received you show on the P&L, correct?
Yeah.
But here we will be adjusting in the asset account. If you're following equity method of accounting, then profit share of investment you already recorded 25,000 in your P&L, right?
Mm.
And again, if you're going to take the dividend there, the total profit there will be 35,000.
Mm.
You understood?
Yeah.
In equity method, we assume that if the invested company they make 100,000 profit, I should get 25,000 as profit because I invested 25%. Correct.
Mm.
So that I already included in my P&L. Got it?
Yeah.
Which is not received actually. Correct.
Okay.
Once the dividend, once I declare dividend and pay me only, then only I will receive money.
Yeah.
Okay. So that is the reason we are removing when we say non-cash and non-revenue expenses we will remove the undistributed earnings of equity method investment. Clear?
Okay.
Okay. Then any amortization or of goodwill, amortization of discount and premium on bonds will be removed. Then items including the net income whose cash effects relating to investing or financing activities such as gain on loss of sale of property and equipment and gain on loss on extinguishment of debt we will remove from the operating cash flow and move it to the investing and financing activities. Clear? All good?
Yeah.
Not clear or what?
Yeah. Clear.
Yeah. Then all deferrals of past operating cash flow such as changes during the period of inventory and deferred income will be recorded here, adjusted. Then all accruals of expected future Operating cash flow such as changes during period in the accounts receivables and payable will be adjusted in the cash flow. Clear?
Yes.
This thing you have to remember, try to understand. Now, for example, current year and previous year. You had accounts receivable. Previous year it was 50,000. Now the accounts receivable is 75,000. What does it mean in terms of cash? You gave more credit, right? Before previous year it was 50,000. Now this year the outstanding is now 75,000. Correct? Nobody's there.
Yes.
Yeah.
Yes.
Yes.
So 25,000 more you gave credit. That means there is a 25,000 cash outflow, kind of.
Yes.
Understood.
Um,
So that's what increase in operating current asset. What do you have to do? Subtract from the net income. Clear?
yeah.
Then the same way, if you talk about AP, last year it was 100,000, and this year it is 50,000. What does it mean?
50,000 paid.
50,000 you paid, right? So that's cash
Yeah.
outflow.
Yeah.
So then decrease in the decrease in the current operating liabilities. What happens? Subtract from the net income. Clear?
Yeah.
This both are considered as cash outflow. Okay.
Yeah.
The same way we can understand these two also. Clear?
Yeah.
Then and non-cash losses and expenses including the net income. What do we have to do? Non-cash losses we have to remove it from the net income, right? So that we will add to the net income that amount. Clear?
Yes.
Okay. Then losses and expenses whose cash effects are related to investing or financing cash flows, we will add to the net income. Why? Because we will add back here and we will adjust in your investing and financing activities. Clear?
Okay.
Then non-cash gains and revenues including the net income, we will subtract from the net income. Then gains and revenues whose cash effects are related to investing and financing activity, you will remove from the net income. Clear? No. So this is a full question. It will take around half an hour to complete. Should we do it today or next week?
Next week.
Okay, next week. Fine. That's it. Okay, then let's do some small cash flow question.
Yeah.
Which one of the following transactions should be classified as a financing activity in a statement of cash flow?
Purchase of equipment.
Purchase of equipment is investing activity, right?
Purchase of treasury stock. Sorry, my bad.
Yes. Okay. 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 All others, did you understand the question? All good.
Yes.
Shilpa, I couldn't hear you.
Yeah.
Yeah. Okay. Now, with respect to the statement of cash flow, the FASB, Financial Accounting Standards Board, uh, Accounting Standard Codifications classifies cash receipts and cash payments arising from operating, investing, and financing activities. All the following should be classified as investing activities, except what? All the following should be classified as investing activities, except one thing. See,
Cash
was
outflow to lenders for interest.
for interest, because we will be lending money for the operating purposes, right?
Okay.
Or it could be financing also. It could be a loan and all. Clear?
Okay.
So yeah. Okay. Cash paid to lenders is part of operating cash flow. Okay.
Mm.
The sale of available for sale debt securities should be accounted for the statement of cash flow as what? Sale of available for sales debt securities. Okay.
Financing.
It could be investing, right? Available for debt securities. Available for sales debt securities means we purchase some debt securities as investments. Clear? Then once when we purchase, we thought we will be holding it till maturity. Then later on, we decided no, we will not hold till maturity. We will sell it off.
Okay.
So it should be under investing, right?
Investing.
Got it?
Yes.
Okay, that's it. Okay. The rest of the portion we will complete in the next class. Okay, thank you guys.
Thank you.